Hey everyone, welcome back to Corporate Decoder, the place where we unpack those dense corporate documents so you don't have to. And today we've got a filing that's all about money being raised, but not in the way you might expect. Let's dive into the Federal Home Loan Bank of New York's latest report. First off, if you appreciate getting straight insights from corporate filings like this, make sure you're subscribed. We also have a Discord community linked in the description below where we chat about all things business and finance. Now let's talk about the Federal Home Loan Bank of New York, or FHLBNY as they're known. This is a current report, essentially an update on significant events happening with the company. The date on this report is July 11th, 2025, but the actual signing date a bit later, July 15th, 2025. Now, before we get into the nitty-gritty, let's understand what the Federal Home Loan Bank of New York is all about. It's not your typical bank where you open a checking account. Instead, it's a congressionally chartered corporation that provides funding to its member financial institutions like commercial banks, credit unions, and insurance companies. Think of it as a wholesale bank that helps other banks lend money to their customers, particularly for housing and community development. They operate as a federally chartered corporation, and their filing numbers, like the commission file number and IRS employer identification number, are just the bureaucratic breadcrumbs that identify them within the system. The main point of this filing, and what really makes it interesting, is how FHLBNY raises its money. They mainly get their funds by selling debt securities, which they call consolidated obligations. These are basically loans they take from investors in the money markets. Here's a critical piece. These consolidated obligations aren't just backed by the New York Bank. They are actually a shared promise or joint and several obligation across all 11 federal home loan banks in the country. This means if one bank falters, the others are on the hook to repay the debt. It's a shared risk, shared reward kind of deal. But who's watching over them? The Federal Housing Finance Agency or the Finance Agency. They set the rules, and importantly, they can even force one federal home loan bank to help another out with repayments if necessary. It's really important to note that even though they are regulated by a government agency, these obligations are backed only by the financial health of the federal home loan banks themselves. The US government does not guarantee these debts, so if things go south with all 11 banks, investors could lose money. Now, the heart of this report is Schedule A. This schedule lists the big debt issuances, the bonds and discount notes that FHLBNY is committed to selling. They exclude short-term debt with maturities of a year or less, which are issued routinely. They also include any debt where FHLBNY has taken over the main responsibility for repayment from another federal home loan bank. The bank is being a bit cautious here, stating that while issuing these consolidated obligations is a big deal for them, they haven't specifically called out any single issuance as being particularly important or material on its own. This is a common way for companies to manage disclosure, acknowledging the overall activity without singling out individual deals unless absolutely necessary. Another key point about Schedule A is what it doesn't cover. It doesn't include any hedging activities like interest rates, swaps, or other financial tools they might use to manage the risk associated with these debts. They're focused purely on the debt itself, not the strategies to manage its financial impact. And here's a crucial warning for anyone trying to track their total debt from this specific schedule. Schedule A isn't designed to give you the complete picture of all their outstanding debt, because it excludes those short-term discount notes and doesn't show if new debt is just replacing old debt. You can't use it to figure out the net change in their total borrowings. For that, you'd need to look at their full financial statements in their regular periodic reports. Finally, the amounts listed in Schedule A are the face value or par value of the debt. This might be different from what appears in their official financial statements prepared under generally accepted accounting principles or GAAP. That's because the face value doesn't include things like discounts or premiums they might get when they sell the debt. So if you're comparing numbers, always remember that the face value isn't the whole story. The really detailed breakdown, the actual list of these consolidated obligations, is found in Exhibit 99.1. This exhibit is essentially Schedule A itself, and it's where you'd find the specifics of the bonds and notes issued. While we don't typically go deep into every single line item in such schedules because it can get a bit dry, the key takeaway is that FHLBNY is actively engaging in the debt markets to fund its operations. And as always, you'll find the cover page interactive data file, which is basically a machine-readable version of the report for easier data processing. The report is signed by Benjamin Tan, who holds the title of Assistant Treasurer. This signifies that the information has been reviewed and approved by someone in a senior financial role within the bank. Now, looking at this filing from a broader perspective, what does it really mean for the Federal Home Loan Bank of New York and its members? The FHLBNY, like all federal home loan banks, plays a crucial role in the US housing finance system. By issuing consolidated obligations, they are essentially tapping into the global capital markets to provide liquidity to their member institutions. This liquidity is vital for enabling those members to make loans for homes, businesses, and community projects. The fact that these obligations are joint and several across all 11 banks is a fundamental aspect of the system's stability. It creates a mutual support mechanism. However, it also means that the creditworthiness of the entire federal home loan bank system is interconnected. An issue at one bank could potentially strain the others. The absence of government guarantees is a key point of risk for investors. While the system is regulated, it's designed to be a self-sustaining entity. This means that the underlying performance and financial health of the member banks are paramount. From a Warren Buffett-style analysis, we're looking at a utility-like institution that provides essential services. Its strength lies in its mandated role and its access to long-term funding through the capital markets. However, its risks are tied to interest rate fluctuations, the health of the housing market, and the financial stability of its member institutions. The disclosure about excluding derivatives and short-term debt from Schedule A suggests a focus on transparency for the specific long-term debt issuances, but it also means a full picture of their liabilities requires consulting multiple reports. Ultimately, this filing underscores the ongoing operational needs of FHLBNY to raise substantial amounts of capital to fulfill its mission. It's not about short-term profits, but about providing consistent, reliable funding to the housing and community development sectors. The key indicators to watch for FHLBNY and the broader system would be their ability to manage interest rate risk, maintain strong relationships with their regulator, and ensure the continued financial health of their member institutions. Alright, that's our breakdown of the Federal Home Loan Bank of New York's latest filing. What's your take on these financial maneuvers and what they signal for the housing market? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description to join the conversation. Thanks for watching. See you next time.